When the USA cut rates, Canada cut rates, we thought they were supposed to be brothers, but not anymore. The divergence between US and Canadian economy has officially widened in 2025. The last time we saw US and Canada on two different economical paths was over 10 years ago due to oil supply shock. To regular people like you and I, this is time to think about whether you want to hold more USD or Canadian dollar. And thinking further ahead, should you buy a property in US or Canada? So what happened? Why does the two countries no longer in sync? In this episode of the USA Update, I'll break down the economical and geopolitical reasons why the interest rate has differed between the two countries. More importantly, I will explain how this is going to affect your life and how you can plan ahead to make better financial decisions. So for years, the US and Canada move in sync in terms of GDP, interest rate, and the whole economical policy, but why now is different? So back in 1970, US and Canada weren't too far apart. Fast forward to 2024, the US is ahead by $22,000 per person per year. Both countries grew steadily, but the US accelerated way faster post-1990. Canada's GDP per capita flattened after 2010, while the US kept climbing. Canada's growth stalled. Why? Slower productivity growth? Higher taxes? Immigration policy? It's really a mix of everything. Meanwhile, the US has stronger tech, finance, and business expansion that are driving the GDP higher. The big question is, can Canada catch up the 22.1K GDP per capita gap? Without major economical shift, this trend can continue, and if you're in Canada, you have to think about how to build your wealth differently. Now let's hop into interest rate. Is Bank of Canada really in control? Let's look at this chart. The Bank of Canada is the white line, and the Fed's is the blue line, move almost identically. Since 1993, they have only diverged by more than 0.75%, about 26% of the time. In 2020 to 2024, same pattern. Both hike rate fast, now sitting around 5 to 6%, the highest interest rate since 2007. The Bank of Canada acts independent, but let's just be real. The US always led the way, so this time might be different. Watch closely. Now, how does Biden and Trudeau's economical policy differ? Biden is focused on big spending and big debt, pumping trillions into infrastructure and green energy and social programs. High corporate taxes, more regulation, and trying to close the wealth gap. In terms of inflation, Biden's not afraid to run the money printer to keep things moving. What about Trudeau? I read through this 81-page of federal blueprint for prosperity so that you don't have to. Canada run higher taxes and more government control. Canada is pushing for universal healthcare, carbon taxes, and the wealth redistribution. It's achieving this by tighter fiscal policy, less stimulus, but more focus on stability, even if it growth lags. What about housing crisis? Keep pushing immigration while supply just can't keep up. To sum it up, Biden's bet on spending big to grow big. Trudeau's plays it safe, and Canadians feel the squeeze. On the side note, if you're getting value from today's USA Update, I would like to ask for a big favor. If you can click the like button and subscribe, even though it's just 2 clicks, it will greatly help out the channel. So if you think I deserve the 2 clicks, please do so. And now that we look at the difference in GDP, interest rate, and the policy between our two president or prime minister, will the money flee to Canada or flee out of Canada? Let's look at the scenario 1. If Canada truly becomes the safe haven for money. And like I did it earlier, I read through the monetary policy of the interest rate and Canadian dollar from the Bank of Canada's official document, so you don't have to. And here's a summary. Will the rate cuts crash the Canadian dollar? Interest rate matters, but not that much. Cutting rates can weaken the Canadian dollar, but it's not the biggest factor. Global market move actually runs the show. When investors feel risk, they pull out of Canada. That moves the Canadian dollar more than the rate cut. If the Fed stay high, the Canadian dollar can drop. But trade policy and global sentiment plays a bigger role. So if you bet on Canadian dollar, have a lot of Canadian investment, watch the global trend closely. Watch the global markets, not just the rate cuts. What about the 2025 housing market outlook from the Canadian Mortgage and Housing Corporation? Lower mortgage rate can ease qualification rules are set to unlock pent-up demand, boosting sales and prices in short term. Now, theoretically, by easing the qualifying rules can attract more buyers. But whether people feel confident to release the pent-up demand is a whole different story. Housing is one of the biggest investments for most people. So unless they feel like this is a good long-term investment, they will not actually take action. Also, the housing starts slow down. This is a leading indicator. Overall housing starts will slow from 2025 to 2027, mainly due to fewer condominium apartments being built. Building condominium usually takes years just to get the permit, not to mention the planning side of things. Due to the high interest rate for the last 3 years, Not much transaction or even building permits has been submitted. Therefore, this lagging effect can further contribute to housing shortage. Also, tariff and the reduction in immigration policy can pose a significant risk. Now, it's worth noting that CMHC has been wrong many times in the history. Think about it this way, when the government official proposed their outlook, the effects already been felt by the general public, but whether they believe in that outlook is a whole different story. So please take caution. Since I'm a Canadian, I really want the scenario number 1 to happen, but I really have to take an objective view and look at the scenario number 2, which is US pull all their capital back. Foreign direct investment trends suggest investors continue to see opportunity in Canada. Over the past 3 decades, FDI flowing into Canada has increased with an average annual growth rate of approximately 7.4%. But there is a but. Canadians are also investing more money in foreign markets than ever before. And comparatively, the increase of money leaving Canada dwarfs the growth in money flowing into Canada, a trend that has become particularly evident since 2014. Investment flowing into Canada has increased at a rate of 6.9% per year since 2014, while the money flowing out of Canada, which is the outbound of FDI, has increased at a rate of 11.1%. So that means while money flowing into Canada, Canadian capital is leaving Canada even faster. This is Canada's foreign direct investment. The gray line is the outbound money leaving Canada. The black line is the inbound money flowing into Canada. As you guys can see, since 2014, the gap between the money leaving Canada has widened the gap between the money flowing into Canada. And now that we look at the 2 scenarios, we cannot ignore the future outlook for USD and Canadian because currency risk is a real thing. So I'm looking at my trading view between US dollar to Canadian dollar. Since 2002, US dollar to Canadian dollar was at 1.56, right? And it continued to drop into 2008 to 0.94. And this is the time where Canadians having a good time crossing the border and go shopping in US like a boss. And things start turning around and the US to Canadian dollar has continued to be stronger into the 1.4 zone, and right now it's sitting at around 1.43. And now that we know the history of USD to Canadian, now let's look at the forecast for this year all the way to 2030 and moving forward. And here are the analysts' US Canadian price projection for 2025. From Traders Union, you can see that the average is looking at 1.44 in March, going to December was 1.48. So US dollar continued to be stronger. Coin Codex averaging same thing, 1.47 to be more aggressive of 1.63. Wallet Investor, you can see that the maximum is about 1.4 to 1.46, so smaller range. What about for 2026? It continued to widen the gap between USD and Canadian. It's looking at the mid-year of 1.58 to the year-end 1.50. And Coin Codex is even more aggressive, going to 1.64 to 1.8. And this is a level that we have never seen for the last 25 years. Now let's fast forward to 2030. You can see that the Traders Union is looking at mid-year 1.59 to 1.66. Overall, the analysts seeing US dollar appreciate over the Canadian dollar for the following reason. Stronger US development in AI can keep the US dollar strong. And high interest rate in USD will attract more investors to leave their money in the US Treasury bonds. Higher interest rate will attract more investors into US as the free risk rate will remain longer. And also the slowdown in Canadian economical growth will suppress the Canadian dollar. And why is this happening? Higher taxes, more regulation, and the uncertainty in Canada is really scaring a lot of big money away. While these forecasts offer valuable insights, it's key to remember that the currency market are greatly influenced by the economical events, geopolitical tension, and the market sentiment. And it's also worth noting that JP Morgan has published its alternative investment in 2025 and their top 5 themes to watch. First is the persistent US housing shortage is boosting real estate development. So you can consider investing in housing projects or REITs while supply shortage could drive up property values. And while the interest rates are normalizing, private equity might be a good play. Higher rates means more opportunity for buyouts and acquisitions. So watch for private equity heavy stocks. And also tech industry and innovation will attract capital, so position yourself early. But keep in mind, always stay diversified so you can capitalize on these trends. So as you can see here, big banks are preparing for expansion, hedge funds are diving into real estate development, and the housing market is evolving with significant institutional investment. And now that we know what the front runners are doing, what about the inflection point? So what is the inflection point? Inflection point is when the market officially turns, and here's how you spot it. Spotting inflection points could be tricky and it needs a lot of practice and experience. But here's a few things you can look at. Looking for shifts in economical policy, like easing regulation, dropping interest rate, and stimulus from the government. And second, like we mentioned earlier, looking at where the institutional players are placing their bet, and as a small fish, you can just follow. Of course, with caution. And also tracking the news, but not in the traditional way. You're looking at where there's a lot of bad news come out, and that's usually when the bottoms will happen. As the news often lag behind, and stock market and real estate market will take action before the bad news actually comes out. And you can use this to confirm your bias. Before we go into the biggest implication for you, I just want to say that if you stay up until this point, good job. So give yourself a like, make sure you subscribe if you want more of this kind of content. It'll really greatly help out the channel and I'll really appreciate it. This picture really shows the S&P 500 stocks categorized by sectors and industry, and size represent the market capital. You can see that technology take up about 33%, and then financial, then consumer cyclical, and then communication, service, and healthcare. So I believe that technology and financial will continue to lead the growth in the stock market. And if you enjoyed today's video, I know you'll also enjoy this video on my channel talking about Trump's real plan for the next 4 years and a recession is needed.